Howdy. Welcome back to Dion Talk. One of the things I do on my channel is I try to bring in people who have done strategies or tactics that I don't do. I've had people come in and talk about DSCR loans because I haven't used one yet. I've had people like Millennial Mike come in and talk about investing at a distance because I haven't done that yet. So today I have Christian from Cody and Christian Multifamily Strategies to come on here and explain something to me that I have some questions about. Now, Cody and Christian are killing it.
Thank you.
They're both significantly younger than me. They have acquired a lot of units in a short amount of time. And the brilliance of their strategy is that they're not using traditional lending. All of my deals are from the MLS. I use conventional loans. I use real estate agents. But what Cody and Christian are doing is they're reaching out to owners and they're using seller financing as a strategy to grow a massive portfolio really quickly. And the brilliance of this is we know that the benefits to seller financing to the seller is they can avoid a large capital gains hit. Mm-hmm. They can get consistent payments without having to deal with tenants, termites, and toilets. Are there some other benefits I might be missing to the seller?
Sometimes if the property is in disrepair, it's not otherwise bankable. They're either looking for someone to take the problems, fix them, and then refinance. So there's a few other things they would do. But ultimately, what we have found is that the people who have seller financed the most to us, or at least the most consistently, are further along in their investing career and they have more time than they have money. So I've found beyond the traditional reasons of why someone would seller finance to you, if you build a relationship with people, and it's a smaller circle than you think in multifamily, there's not that many players. But if you can get into that circle, meet the right people, and just learn how they did what they did, not only will they teach you how to play the game, but they'll invest in selling to you. So if you ask, how do you recommend I go forward? We find those are the people who want to play bank because they want to help move us forward as much as they want to sell the property. And that's where we get more creative.
What I really like about seller financing is with a strategy like mine, I can have up to 10 mortgages in my own name where I get, residential lending, the best interest rates. I've house hacked twice, so I've gotten low down payments. With seller financing, these loans don't go onto your record as far as counting against the 10 that you can have in your name. Most people make this huge mistake when it comes to seller financing. And we think things like, I need to pay a high interest rate, or I have to set up a balloon payment, or I have to only amortize it over 5 or 10 years. But when we present something like seller financing to the seller, most sellers have never heard of the concept before. And whatever we tell them is going to be the only thing they know on how it works. So the barrier to me, because someday I am going to do an owner finance deal.
But not today.
And until then, here's the barrier. One of the reasons why I've stayed with 4 units or less is because I can get 30-year fixed rate debt. Now, I know it's possible to get 30-year fixed rate debt with seller financing. Michael Zuber from One Rental at a Time actually did it one time with 0 interest because what mattered to the seller was the price point more than anything. What is your plan for the seller financing deals that you're setting up that have a balloon payment at 5 or 7 or 10 years?
It's a good question. Cody's first deal actually is another seller finance deal, fully amortized over 30 years. So Cody did it with a 12-plex. It is doable. The first thing with balloons is you have to do 2 sets of math. Now, when you're buying conventional, you're using a product where the property will pay itself off over 30 years, typically, or 15 or whatever amortization you have. With a balloon payment, there's just a lump sum that's due somewhere in the middle of there. So first thing you do is you don't stack all those balloons in the exact same place. I have watched people do that, and you owe 100,000 here, 100,000 there, $1 million over here. And when all that happens at the same time, it's a cluster. You don't want to do that. However, our strategy is one, I have a few sellers who their goal is to convert their portfolio into notes and pass that on to their children. For that, we're doing what's called a seller refinance. Seller's already the bank. You can keep the seller as the bank as long as you want. They want the balloon payments to stack in a way where they can adjust for inflation, and they want an option to have to renegotiate. So the balloon exists with that strategy. The rest of the portfolio, we're going to have to refinance. Your options at a balloon is an exit from your current debt. You either have to sell, pay it off, or refinance. And those are your only 3 options. So what you do is you do your math up front. Always conservative math. You calculate the deal. Day 1. Is it a deal that cash flows, that you can buy, and that you're confident you could hold forever? Yes. Excellent. Now, what is your exit? Let's use a 5-year balloon for an example. In year 5, I need to know that I have a position where I could take this to the bank. If it's a property in bad repair, I know that I have time to make my repairs. I have money to make my repairs. I'm going to have at least 30% equity in that property at the time of refinance. At that point, you have years of solid bookkeeping that you can bring to the bank. You have a property that you've had time to operate, manage, fix up. So now you have a nice roof, excellent plumbing, a good set of books, and 30% equity. You check all the boxes that the bank is looking for. And that is what you need to do on any deal with a balloon. That applies to commercial debt as well. If there's a balloon, your analysis up front is conservative. Your analysis on the back end is really conservative. Rents always go up. Almost always. There's very few times rent is pulled back. However, I don't factor for rent growth in this at all. I go, what is market rent today? We're going to push to 90% of that. And that is the numbers that I'm looking at 5 years from now. It's likely going to be much better. Properties typically appreciate over time. I assume the property is not going to appreciate. Unless I'm doing a major change that has forced appreciation I can factor for, I'm going to assume the market does not move at all from today to 5 years to the future. If those numbers tell me I have more than 30% down on this property and it will be ready to go, that's our exit. We're going to convert into bank debt, or we're going to refinance with the seller. Hard part with our strategy is you do have to do that cycle. It's not often. It's every 5 to 10 years on a property, but you do enough of these deals with enough balloons, and it just comes a part of your annual, unfortunately, a little bit of active income of, all right, I have to do my rounds with the bank. However, this has allowed us to, in the last year and a half, I bought 77 units, which is a lot.
So let's cover that really quick. First, how old are you? How old is Cody?
I am 30, and I thought I was going kind of fast until I met Cody. I had 4 units at 29. I have 77 at 30. Cody is 22. He started investing at 19. He is at 87 units.
My favorite thing that Cody said when he came on here and did an interview, he was 21 at the time. I think, I forget how many units he had, but he said, I really wish I started sooner, which is what every investor says. So, okay.
If only he started when he was 3.
Right. And how many units do you guys have now?
Right now, between the two of us, because we're partnered on almost all that, I have a duplex and a house he doesn't have. So between the two of us, we have about 90 units. We're under contract for another 8 and looking at a lot of other opportunities through the year. But we should, in the next couple months, break the 100 mark, which will be fun. Just add a digit.
Okay.
But that's where we're at. All seller financed, with the exception of my first duplex, and my second duplex was actually hard money. But outside of those two, we've bought everything seller financed.
Okay. So now I'm going to make a suggestion and then say something you might not like.
Ooh, I'm looking forward to it.
So the first thing is, if you're under 40, I want you to look up this course, and it's called
themultifamilystrategy.com.
The reason I say under 40 is because I'm over 40. And an aggressive seller finance growing portfolios with balloon payments is not something I want to do at my age. I like the 30-year fixed rate debt. I like getting to cash flow that I can retire on in 10 years or less. I like the simple path to financial freedom. If I was under 40, and in the Marines, we would call you guys hard chargers.
All right.
Get out there and charge hard to build a portfolio like this, because you have the decades to take the risk. Where you can have issues with balloon payments, you still have the time to recover from it. But if you're a little bit longer in the tooth, I don't know that this is the strategy I would recommend. So that's just my personal opinion though.
I respect that. My opinion, regardless of your age, is know your goal and know the why behind that goal. If you have some target that is this high and you need a different strategy to reach it, I would pursue that strategy. If your why is large enough, if you want to gain financial freedom so you can buy the McLaren, that's probably not going to be a big enough reason for you to charge as hard as Cody and I charge. It is a very active, it's not the easy way to get financial freedom in real estate. We do a lot of renovations. We take on a lot of problems. It's a very, very active strategy. If you are 50, 60, but your goal is, hey, I want to get to 100 units and I have a specific reason that means something to you beyond I just want to be rich, I would go for whatever strategy gets you to where you want to go. That's my 2 cents.
Fair enough. No, I like it that we disagree.
So no matter what your age is, buy my course. I'm kidding. The goal is never to sell this. But if you do want it streamlined, that's the only reason we came up with the course is we just made it. You do this all for free, 100%. It's on YouTube. You can follow Dion. You can follow our channel. The content is free and you can do this if you want to streamline it. That is the only reason we put together this course. You can do it on seller financing, themultifamilystrategy.com.
And I've looked into putting together a course. It's actually a lot harder than investing in real estate.
It is. I can promise you the hours and money invested in a course is brutal.
So David Green says this a lot more eloquently than I'm going to on BiggerPockets. Investing in real estate is not easy, but it's not complicated.
Mm.
The strategy that you guys use is you can duplicate it. You could do it over and over and over. And as you learn the skill, you get better at it. My twist is it can be easy because in my opinion, it was a lot easier to buy a rental every couple of years than it was to work 50 hours a week. More than 40 hours a week for more than 40 years to retire on less than 40% of what you're making is not the easy way to live life.
Mm-hmm.
So while a lot of strategies might not be as easy, there are easy ways for you to invest. If somebody wants to reach out and get a hold of you, I know we have the website for the course, but how can they find you guys?
Easiest way to find me, I get messaged so many different places. I don't know why. Instagram seems to be the one that's easiest for me to track. So if you follow me on Instagram at Christian Osgood, I'm most likely to respond to you there.
Awesome. Thanks a lot for coming on here today.
Absolutely.
I appreciate it.
Until his next video, thanks for coming to our Dion Talk.
We're sorry, the number you have dialed is not in service at this time.
Bonus content. I know we've already ended, but if we just keep this rolling, if you are looking to do seller financing or it's a game you want to play, the game is only about making relationships. You're going to move from transactional and looking for deals, which is a fine way to go, especially if you're going at a pace where it's a few rentals a year. The nice thing is it's not that hard to find a few rentals a year if you're looking for it. If you are looking to build seller finance deals, it's all based on relationship. Don't focus on the transaction at all. You're not looking for properties with problems. You're not looking at properties at all, other than I'm going to find a building I'd one day like to own. I'm going to find that owner. And I'm just going to call them and ask how they got where they are. And sometimes they'll just say, hey, you're super weird. Why did you ask me that? And that's excellent. I'm like, well, that's the reason I'm calling. I don't know anyone else doing this. You've done something I've never done before. This is where I'm at and who I am. I don't want to buy your property because I don't know how I would. I just want to learn how you got to where you are today. If you build those relationships, deals will take care of themselves. But for anyone stuck and looking to follow that strategy, stop looking at deals, stop looking at properties, just meet other owners of properties and just be a normal human being. And you will go so much farther, so much faster.
Awesome.